It's time for the Phil Ferguson Show, only on Secular Media Network.
Hello, everybody. This is Phil Ferguson, and you are listening to The Phil Ferguson Show. This is show number 177, and I've got a lot of thoughts swirling around in my mind to try to get to. So I've got some kind of interesting stuff to talk about as far as investing. I'm going to try to answer a handful of questions that I've received in the last few weeks and months from different listeners, and trying to push it all together. So I'm not quite sure how this is going to work out yet, but we'll have fun trying. And then later in the show, we're going to have the interview with James Lindsay, and his book is Everybody is Wrong About God. So you're going to find that fascinating, and we're going to have a nice discussion about what we think about God and why we think about God and why all you fuckers are wrong. So hang in for that. You're going to enjoy it. And before we're going to get into that, we're going to talk about a subject that I've been battling with over my head, how to present it. And I'm still not sure exactly what I'm going to do here. But it's called tactical investing. And what tactical investing is in a very general sense is that you look at some kind of data and you make investment decisions based on that data. And that data will guide you how to buy and sell things in the market. And it could be something as simple as price-earnings ratio. It could be complicated graphing techniques, something called head and shoulders. So like if a stock goes up and then down a little, and then up a bunch, and then down a bunch, and then up a little and down a little, the graph kind of looks like a human being's shoulders and head. So that's called the head and shoulders. And that's supposed to be indicative of something. I don't even fucking remember. And there's going to be people whose heads are going to explode when they hear this because they place value on that. And I clearly do not. There's many endless strategies, and the vast majority of them do not provide market-beating results. Now, can you find some that for some period of time have provided market-beating results? Certainly you fucking can. However, how do you know which one in advance to buy? That's the problem, and it's the same thing with mutual funds in general, is that you have all these highly educated professionals that buy and sell stocks, but yet mutual funds as a whole wildly, materially underperform the market. And all of these strategies materially underperform the market. So I'm going to go over a couple of them. And I had one of my listeners write in just recently, this kind of spawned this, that had a specific tactical fund that I'm not going to go over because their webpage was painfully obtuse and lacking information. But basically, they look at all kinds of factors and they figure out when stocks are going to go up and when they're going to go down. And they buy when they're going to go up and they sell when they're going to go down. This is part of the tactical tactical strategy, is not to get caught short or not to get caught owning something when the market goes down. So again, it's this magical promise that when the market goes up, they're going to make money. And when the market goes down, they're not going to make money. But what I'm going to do is I'm going to talk about a couple different things. One is the Motley Fools. I have had people ask me many times to talk about the Motley Fools. And so I'm going to talk about one of their specific things. And this is called the Foolish Four. And this was a strategy that they proposed way back. Oh, shit. I had this in front of me here. Hang on a second. I think it was 95, 96. Yes, 1996, give or take. It started in 96. And what they had done was they had found this magical formula that would allow you to beat the Dow. And, for people who invest back in the 40s, 50s, and 60s, the Dow was everything. And now it's realized that those 30 stocks are not always even the biggest companies. And it's not really a good measure. It's still quoted today. And of course, it has the really long and venerable history. But I much prefer the S&P 500. Matter of fact, I even prefer the Wilshire, what's called the Wilshire 5000, although Dow Jones bought that, and you generally have to go through a paywall to get access to the data. where the S&P 500 publishes the data, and the S&P 500 is the 500 biggest companies and fluctuates from time to time with the whole market, but over the long run gives us pretty much the same results. And you can easily go check that data on Wikipedia so that you're not reliant on me telling you what the results are. You can go look for yourself, and that's important to me. Anyway, back to the Foolish Four. The Motley Fool group has a podcast that's very entertaining, very enjoyable, and they often talk about how to pick winning stocks. And they come up with all kinds of strategies and plans, and they have all kinds of portfolios. And, of course, you can hire them, which good for them. I mean, that's kind of the same thing I'm doing. I just have a different philosophical approach than them. And they come up with ideas, and this was one of their early ideas. It's called the Foolish Four, and I'm going to read a little bit here from Wikipedia, so forgive me if it sounds like I'm reading here. The Foolish Four is a discredited, which is why I'm talking about it. It's kind of funny. Mechanical investing technique that, like the dogs of the Dow, attempts to select a number of Dow stocks that will beat the Dow Jones Industrial Average and outperform it in the near future. So the Dow Jones, again, is 30 companies. Usually they're 30 large companies, and usually they're industrial companies. Dow Jones Industrial Average is what it stands for. So it's 30 different stocks. It's not 500. It's not 5,000. It's 30 stocks. And several of the people at the Motley Fool found this spot, this method, this formula that if you follow this, you can beat the Dow Jones by quite a bit, several percentage points a year. And they came up with this Foolish Four. And so I'll go back to Wikipedia here and read again. To identify the Foolish Four, an investor determines the current dividend yield and current price for each of the 30 stocks comprising the Dow Jones Industrial Average. Then the yield of each stock is divided by the square root of the stock's price. The stocks are ranked from highest to lowest using the number resulting from the division. The stock ranking the second highest, the third highest, the fourth highest, and the fifth highest in equal dollar amounts are bought, and the highest ranking stock is not bought. Okay, yes, you heard that right. And for those of you who are mathematically inclined or a little skeptical, you should realize that this has nothing to do with the value of the companies or what they're actually worth or anything like that. It's simply the dividend yield divided by, I think it was the square root of the stock's price. What the fuck is that? And, of course, the company that's doing the best on this scale, you don't buy. So this is basically data mining writ large. We do not accept this with astrology. We do not accept this with homeopathy. If you find that a certain percentage of people that take milkweed get rid of a rash caused by chickenpox, you don't just go and buy homeopathic milkweed. You know that in its essence it can't work, even if there's some piece of data that shows. If you look at enough data long enough and try enough bizarre combinations, you can find patterns. That's part of randomness. Data that is massive and random will have patterns in it. That's how it fucking works. It doesn't mean that that pattern will continue into the future. And so that leads me to look at, and this was kind of nice but a little funny, is that I found the best research and data actually published at the Motley Fool. So they kind of acknowledge that this doesn't work, but they can't just give a full-throated acknowledge, I guess that's the right way to say it, that it doesn't work. But they did give you the data, which is nice. The data that they have here is from 1960 to 1995. This Foolish Four would have helped you beat the Dow Jones Industrial Average by 2.4% per year. Now, the first thing to keep in mind is, like I said, this is data mining. This is what I often call, and it's called in the industry, back-tested data, where you test something by coming up with a strategy and then going backwards through the data. Completely fucking worthless. I cannot stress how worthless this is. It's beyond worthless. It is delusional. It's trickery. It can convince you of something that is real that's not there. And so what kind of sparked this whole rant, like I said, I had a listener said they found this tactical fund, and they understand that the backtesting data is not reliable, but it's really good in this case. It doesn't fucking matter. It can tell you that sunshine and rainbows will happen every day if it's backtested. It doesn't matter. Backtested doesn't really show you that it's going to beat the market. It's really hard to do, and it's data mining. And like I said, we don't accept it in other parts of the skeptical community. Why accept it in the stock market? But their result was that you would beat the market by 2.4%. And so they created a fund, or they created this strategy. And you could buy this strategy. You could follow this fund that they have. You could have them help you invest. And from 1996 forward until this article was written in 2000, so 5 full years of this strategy working, and they underperformed the Dow Jones Industrial Average by 5.27% per year. And you're going to love this, with a higher standard deviation. And so what that means is you had more volatility. Your portfolio went up and down. That is to be expected because you have 4 stocks, not 30. You're going to have much more volatility, which is mathematical variation over time. So your portfolio, if you watched it day to day or month to month, which you should not fucking do, went up more and down when you own 4 stocks than when you own 30. Duh, what a surprise there. So it underperformed materially, and then they had this long article on their website explaining why it might not have worked, it couldn't have worked, and they even acknowledged that some of their critics have found them guilty of data mining, and they explain why it's not really that case, and it's kind of embarrassing. And what they did in a classical investment style is they took this portfolio and they rolled it into another portfolio. And so this is very common in the industry, and it's something that almost no one knows, and I meant for it to be a whole topic, but it just popped into my head. I don't know that there's an official name for it, but this is a way to hide your results. Because this portfolio no longer exists, its results are not, you're not able to get them. You can't go look them up. You can't go to Google Finance or Yahoo Finance and pull up the chart or the data because it's not ongoing anymore. It gets blended into something else that's performing better. And sometimes mutual fund companies will do this. They'll launch 10 mutual funds, and 5 years later, 4 of them are doing great. 6 are terrible. They take the 6 and they kill them. And they just send you a letter as the investor that we're rolling this fund into this other fund. And your investment changes overnight. Not that it wasn't going to change anyway. And now they give you the prospectus on your results over the last 5 years from the new fund. And so you could think that you've done really well over the last 5 years, but if you check the fucking math in your own account, you haven't done as well as they're telling you because you weren't in the fund that survived. You were in the fund that is now dead and got rolled into the fund that now survives. And so anyway, that's another game. So this mutual fund company, in this theoretical example, that kills 6 funds and leaves 4, they can say 3 out of our 4 funds have beat the market over the last 5 years. Technically, a true statement, but in reality, only 3 of their 10 funds have beaten the market over the last 5 years. They just happened to kill 6 of the 7 of the sucky ones. And they left one because they still think that it's not so bad or it's something different and they need to have a balanced offering of investments. So even the lofty Motley fools made this proclamation of a way to pretty much beat the market. And so they, it just doesn't work. Another one that I found is a company that approached me about 2 years ago called Tuttle Tactical. And I wanted to read from you here. Hang on a second. I've got to close a few pages. Yes, I'm doing this live. My apologies. Their strategy here is what they're going to do. I'm quoting this from one of their actual documents. You can go on their site. It's TuttleTactical.com. The strategy here. Here we go. Quote, trend aggregation involves using multiple uncorrelated methodologies to determine which phase markets are in. Within the Tuttle Tactical Management Growth Strategy, we optimize among momentum, countertrend, and earning models to determine the best mix of models for a given market environment. Within strategy parameters, analysis results determine which portfolio should have zero market exposure, be partially or fully invested, or use leverage to achieve greater market exposure. End quote. So if you understood all those words, congratulations, because I'm not sure